Hey, everybody. Welcome back to the Today's Market Explained, a 4-star podcast and media event. And today we're doing an interview, and it's going to be a very interesting interview about early stage investing. We've got Drew Oetting on the call with us today, and he is a gentleman with lots of experience working with some of the top people in the venture capital world and early stage investing world in San Francisco, Silicon Valley area. So, Drew, welcome to our show today.
Brian, thank you for having me.
We appreciate it. So we had a little conversation about how you used to be in Iowa, you're in Texas, you're all over the place, but you started out with a venture firm, and your CEO also was involved in a lot of other really interesting businesses. So to give some background, why don't you tell us where you came from before you got involved with this new firm, 8VC?
Yeah, definitely. So as you mentioned, I grew up in Iowa City, Iowa, which is where the University of Iowa is. It's a great place to grow up. And I was obsessed with two things when I was there, which were kind of weird, I guess. One was investing, and the other one was golf. And so I got a recruiting letter from the school called Claremont McKenna. And Claremont, the only reason I really knew it, it's a very small school, but the founders of KKR had gone there, and I'd read this book about them called Barbarians at the Gate and told my mom about it. And so when she saw the letter, she remembered it. So that's where those people you talked about who, you want to emulate one day, that's where they went. And it was in Southern California. I thought there was going to be a beach there. Turned out it's like 30 or 40 miles inland, so there's no beach, but it was an incredible experience. And I studied math and economics when I was there, and I was very fortunate to have a scholarship through a group called Cascade, or the Bill and Melinda Gates Investment Group, which is the family office for the foundation and for their assets. And so I got to learn a lot about investing in a more traditional sense there. And then I also had this kind of weird experience where I went to Mongolia for 6 months, or just under 6 months. And I worked for this American guy who was basically just an entrepreneur, but he described what he did as investing. And it was really like kind of Wild West, frontier, starting cement companies and all this stuff. And so the juxtaposition of those two experiences, it really struck me that investing and business, it could be exciting, it could be entrepreneurial. And it wasn't like really this big distinction. It wasn't just like picking stocks, or it wasn't just, running a company. There could be sort of this mix. And I was very fortunate to get introduced to my long-term business partner and our CEO is a guy named Joe Lonsdale. And I got introduced to him right out of college. Joe had worked for Peter Thiel as an intern at PayPal. And then when he was very young, started a company called Palantir. And Palantir is now one of the largest kind of data analytics companies. And then he started a company called Adapar, which was a software company for wealth management. I was very fortunate to get to go work for him when he was CEO there, kind of as his chief of staff, which was really carrying his bags around, doing whatever he needed. And that was kind of, then he had been doing a lot of angel investing and said, we should kind of start a venture capital business. And along with a couple of foreign business partners of ours, we ended up going and focusing on that.
Well, Drew, this is an amazing crowd of people that you're with. And for folks who aren't aware, Peter Thiel is one of the top venture capitalists in the country, and Adapar and Palantir are some of the top venture capital funded companies and been extremely successful. So you've been part of an amazing group, Drew. And so how did you take it from there to where we are right now?
Well, basically, I think I was just very fortunate to be, as you mentioned, surrounded by some of the kind of the best people, and people who also, I think, uniquely empowered young people. So when Joe started Palantir, empowered by Peter, he was in his early 20s. And, it wasn't like it was a company that, an easy company to start. This was a company that was selling some of the most sophisticated and complex, data management systems and integration systems to, the first customers, the NSA and, the Department of Defense. So it was a huge amount of empowerment. And Joe, I think, if anything, he probably magnified that empowerment that he gave to me and to other people. And so I always feel incredibly fortunate about that. And also the fact that, not only was empowered to do things, but I think, the group of people I was around were so talented that there was a lot of opportunity there. Maybe a lot of kind of, bumper rails for us, just given the quality of people that were around. And so, after Joe replaced himself as CEO at Adipar to focus full time on investing, we went and kind of began building out the investing business and really thinking about, okay, what, the same way you approach building a startup, building an investing firm. At first, Joe, I'll never forget it. Joe said, we were going to raise the largest first time venture fund since the dot-com crash. And I think it needed to be over 400 or something like that. I can't remember. And I didn't know any better. I said, yeah, this makes sense, right? If you can do anything, let's do it. And we had some former business partners who were very helpful in getting us going. They knew more about venture capital, but they thought that was kind of nuts. And so the way that Joe did it, I think it was very instructive for me in my career, which is that we just went and raised it. We didn't have any minimums that we placed on, how much we would take from someone. As long as they were credit investor, they understood what they were doing, and we thought they were ethical people, we would let them invest. And so we raised $448 million that first fund, which is a lot, but it was raised from 282 individuals. So the average check size is pretty small.
Yeah.
Yeah. So fast forward to today, obviously much more.
Well, for you, but funds are much smaller than that. Yeah.
Yes. But anyway, it was really instructive, and I think it set this cultural tone for us as we built our business, which was around, being entrepreneurial and approaching investing in venture capital with the same sort of entrepreneurial mindset, that you take at a company.
Nice. Well, good. So now you have this fund and you're investing. So can you share with our listeners, what kind of factors do you look for in potential companies? And vertical software, health delivery, biomanufacturing, those are the areas I think you're in. What does that look like?
Yeah. So, we focus on the early stage, which is kind of an amorphous term, but what it means for us is it breaks down to a lot of seed investing, a lot of Series A's and some Series B investing. And then we now have funds that are large enough to continue to invest into those winners and support them. But we like to get to know founders as early as possible. And so we think about, while we invest across a spectrum of industries, we like to think about what is the commonality. And really, it first comes down to what risk we're taking, right? So I think if you're an investor, you really want to understand, okay, I'm trying to earn a return, but in exchange for that return, I'm obviously taking risk, because otherwise, it wouldn't be there. So what risk am I taking? And we want to take early stage risk, which means I want to take risk. I want to take product market fit risk. I want to take technology risk. I want to take engineering risk. I want to take, unit economic risk on the sales team. I want to take risk of the co-founders getting into a fight and the thing blowing up. Risk on hiring the first engineer, very early fundraising risk. That's what I want to take. I don't want to take capital markets risk in the sense, I'm not even best of the world. I have no insight on whether something will price at 8 times, 10 times, 12 times, what the capital flows will be. I don't know anything about that. And so what I want to do is I want to, make an investment where if the risk that I'm, feel comfortable taking pan out the way I think they will, it doesn't really matter whether it prices at 10 times or 5 times or 20 times. Obviously, I hope it prices at 20 times better, but I don't want to take that type of risk. That's for later stage investors. So that's what we're trying to do, is we want to be involved in the messy part of a company's sort of life cycle. And that's, we'll embrace that messy part across a variety of different industries. I think that the common thing we ask ourselves when we're deciding whether, an early stage company is maybe a fit for us, is we ask this company, why now? So it tends to be that the biggest companies, and the ones that honestly have the most tailwinds behind them, are built basically, if you look backwards, you'd say, okay, this was not possible 5 years before it was started. And 5 years after it was started, it's pretty obvious. And there's no real reason that it shouldn't have happened earlier. A great example is, Uber, where it was tried many times, to kind of disrupt cab. It was tried, in the .com kind of boom a couple of times. It was tried even after that. But mobile penetration, the quality of GPS, and basically the high throughput of mobile phones wasn't really there yet until basically right as Uber was started. And so something that was a great conceptual idea for many years was not actually ready for prime time until basically that technological revolution that was caused by the mobile phone. And if you wanted to start Uber now, you'd kind of be like, well, of course, it's like kind of obvious. And it's sort of like pretty clear it was going to be started before today because of that. So we look for that why now. And that helps us identify, I think, companies that have the biggest potential and also the most tailwinds. It's not always the case. Like sometimes you're just betting on an entrepreneur. You're like, this person, people have tried this. It's been around for a while. This person's just better. They're going to win. But that tends to be a harder bet to make. And it tends to be much more people-based than a thematic, bet around a set of companies you can make. So we always ask ourselves that, why now?
Many of the listeners know that I was one of the original Hyde Park Angels, and we were doing similar work. And that ended up being one of the top angel groups in the country. And for us, a big part of the success was exits. And I wonder if you could give us a sense, what are exits looking like now? Are most of these companies being bought by a private firm, another venture firm at a later stage, going public? What do the exits look like now?
Yeah, I mean, I think it's you probably know this better than I do. I mean, the majority of exits for a venture cap back business are probably going to be M&A. It may not represent the majority of returns, right? Because the really big outcomes do tend to at least have the potential to go public. But when you're investing at the early stage, you just gonna. The reality is a lot of, especially if you're investing in technologies that are maybe have a lot of, or at least some tangible asset value, but a business model which might be too early, right? Like coming back to that why now question, M&A is going to be very, very likely. I think, the last 3 years, up until kind of late 2022, we had a historic opening of the IPO window. Part of that was driven by the fact that, obviously there were very low interest rates. Part of it was, I think, SPACs helped accelerate it. Part of it was also just the fact that the private markets finally started trading at a discount to the public markets for a very short period of time, because now it's back to the way it had been for the previous decade. So there was a real incentive to go public. But I think a lot of companies, I think a lot of founders in our portfolio, the ones that decided to stay private are very happy they decided to stay private, because, unfortunately, there's not a great buyer of early stage, especially technology-driven companies in the public market. There are, as we have the amount of passive capital that's moved in, it's just not that, like, you're not going to put some $300, $400, $500 million market cap company, in the average passive product. And so it takes a while for companies to build, a real following and a real asset base in the public markets. So I think we'll probably revert back to a place where the public markets are reserved for the really big winners.
Right.
M&A will be the likely outcome for many, other technology companies. I think the one caveat that we are very concerned about is that we think the FTC is very scary, to be honest, right now, in the way that they've positioned against the innovation economy broadly. When you see examples of, I think the most poignant example is in biotech, where these biotech companies, it's always been the understood sort of life cycle of most biotech companies that they're going to get bought, right? I mean, they're not going to try to commercialize. And, the large pharma companies have kind of decided that they are going to mostly buy their innovation once it's de-risked, and then they'll commercialize it. I think it's been pretty good, actually, for patients and for the economy and what have you. I mean, you can complain about it. Yeah, you can find problems with it, of course. But if as you start seeing FTC scrutiny on biotech companies that are pre-revenue, maybe have only done a phase two, and those acquisitions being held up because of potential future monopolies. That starts looking very scary. And so, we're monitoring that, because I think what you'll see the most sophisticated acquirers, like you saw with Microsoft and OpenAI, structuring around it, and sort of doing like these pseudo acquisitions without actually being technically an acquisition. But outside of some of those, and those will probably be really big deals, we are a little bit worried that the M&A landscape may get, and you see it during deal processes for sure, on both sides. So that is one concern with exits that we're paying attention to.
Excellent. Any great successes you can share with us in the recent markets through this weird pandemic stock market?
Well, I would say that, going back to M&A, like because of the nature of lockups on these IPOs and owning a lot of concentrated stock or whatever, and you're kind of like the worst positioned holder of public stock, basically. So like, one is you don't really have the expertise, but two, you might be on a board, right? So then you're really locked up. And so honestly, like our best outcomes, even during the kind of the craziness, other than maybe some sort of anomalous outliers, we're actually companies that were bought, M&A. Like we had a company called Deliver, which was bought by Shopify for about $2.5 billion, and turned our kind of 2016 fund. And that was an M&A event. It was a very strategic acquisition by Shopify. It was not just for pure financial reasons, that they bought it. And we've been investing in that, we did seed, the A, continue to invest kind of in that company. And that was, I think our best, or one of our very best outcomes. And it wasn't really driven by, timing the stock market right. Because I just think structurally we're not super well advantaged for doing that. Sometimes you get really lucky, like, with Palantir, it became sort of a meme stock for a while, and when it traded up past $40, and we were all like, this is nuts. And now it's back down to a level where I think it's performed incredibly well operationally. So now it's at a level we think it's actually maybe more sane. And we had other ones we think are, massively undervalued. The market didn't like them. They trade down, and, you lose investor support. So,
Right. I
think our best returns, at least the most, like the ones that we feel kind of the most confident about, still have come from M&A mostly.
Mostly. Okay, good. Any in the hopper that are doing really well right now you want to share? You can share with us?
A bunch are doing really well, right? At least they feel like they are right now. It all kind of depends on the stage. I could highlight a couple. One is this company I'm advertising right now called Loop, which is one of our best early stage companies. It's a payment infrastructure company for freight and supply chain. So you have, we do a lot in logistics and supply chain. One of my partners, Jake Medwell, has really built that practice out for us. Done a great job of it. And logistics supply chain is a really interesting space because you have two things that make it, from a why now perspective, really great. The first is Amazon kind of laid down a gauntlet in 2004, 2005 by starting to invest in their supply chain, and really vertically integrate it. And so the average package on Amazon's network went from, before they started doing that, maybe 2004-ish, over 1,000 miles between where it originated and where it ended up. Today it was 75 miles a couple of years ago, so it's probably below 60 now. So that's a magnitude change. And then the other thing is the average time to delivery has gone down, pretty dramatically. Now in many cities you can get certain items in 3 hours, right? Which is pretty impressive. So the complexity of that on the rest of the ecosystem, whether you are a supplier to Amazon, whether you're a vendor in their ecosystem, or whether you're a competitor to Amazon, right? You have to compete with that. And the only way you can compete with that is if you also have a digital infrastructure and basically real-time data. The logistics industry has always been very good at optimization, right? Like think FedEx and UPS hired more, operations research PhDs than like anyone else. Sort of, it was basically, I think U Chicago actually had one of the best programs. Um, and so they always understood the power of it. It was always part of their DNA, but you needed that data infrastructure in a really software defined environment to be able to do it. The second so there's a big why now there. And the second is it's a very competitive market with low margins. And there was no ability to hire their own large internal tech teams, unlike at a bank or at large health insurance companies, whatever, that have their own relatively sophisticated infrastructure. So selling as a startup into the ecosystem, you didn't have antibodies inside of these organizations, even the large ones. There's many, many, many customers, right? It's not like there's 5 customers, you got tens of thousands. So it's a really great place. And so what Loop does is, when you have a contract between someone shipping some chickens and the carrier bringing them there, and then the cold storage warehouse, there's over 150 variables in that contract that determine actually how payment ends up being. How long was the delay, at the warehouse? What was the price of fuel across XYZ route? Whatever. There's 150 of those variables. And so what ends up happening is, in kind of the old way of doing things, those contracts are effectively arbitrated either by a BPO or by an internal team, and it delays payments, leads to lots of errors, difficult forecasts, et cetera. What Loop does is that they automate that process. And it's basically one of the best teams we've seen, very senior folks that came out of Uber Freight. And so it's a really exciting company that's early stage. They have a based in San Francisco and Chicago.
So is it relating to the Loop?
I think that it does have some DNA from that. So yes, they do. Yeah,
which is our city, of course. Interesting. So Drew, what else are you seeing out there? What kind of opportunities are there that become more interesting and have that why, like in this environment now with post-pandemic and very strange economy, pre-recession, whatever we're going through right now?
Yeah. So I think that, one that we've been investing in, I think as long as anyone, is obviously defense. It's now become much more, common, to kind of have that recognition, I think. But we've been investing in basically new defense technologies, for, our entire, entire fund life. And I think the why now there is as great as it's ever been, if not greater. I think there's also an interesting thing, which is that it used to kind of be that there was like a collection of people, and I'm going to say in Silicon Valley, I don't actually mean they live in Silicon Valley, but like of that ethos, right? The startup type people. There was like a small population who were very attracted to problems like defense. And then there was like kind of a general, like the general, like sort of, it was taboo among like the general population of folks. They didn't want, everyone now kind of realizes, like these big tech companies that were not willing to work with the US, Defense Department were willing to work with maybe some of our, adversaries. And that's changed. I think that, and that's a good thing. There's now a much wider population of really talented people, who are some of the most technically, oriented people in our society who are interested in working on, defense technologies. And I think that's great.
Do you think that the market's getting oversaturated with too many people in it now?
I think in defense, you are right that you have to have very, very senior teams and a very diversified set of skills. And so you can't like start a great defense company with like $1 million and, your friends right out of school. The business development component of it is incredibly sophisticated. The types of technology you have to build, you need to build both software and hardware almost always. Palantir's maybe an exception there. And so you need really both, highly skilled, but also more senior engineering. And then you have like very long sales cycles. So you need a capital base that is very long-term oriented, and also is like willing to front a lot of money. And that tends to follow like, much more senior kind of founders. So, we only will do like one or two defense companies, in every fund. I'd love to do more because I think it's a great area, but it's just that the like, it's a little more deterministic in terms of the type of people, capital, experiences, that they need to have before you can really, dive in. So I don't see it as saturated necessarily in the sense that it's not like generative AI or something where like everyone wants to work on it. But it is saturated maybe, or getting more saturated in the sense that we will see more tourists within it as opposed to people who've like dedicated and been obsessed with it. It's almost easier as a filtering function as an investor when it was taboo, because then the people who did it like really believed it. But I still don't see it as like saturated relative to other parts of the early stage ecosystem.
Okay. I see a couple different companies that you've had here. One is the Boring Company. Is that relating to the Elon Musk story?
Yeah, exactly. Before we started recording, we were talking about traffic, right? So,
right.
One of the greatest regressive taxes on society is traffic. So, yeah. If you're very like you mentioned, traffic is it's a symptom of economic health, right? We have a lot of people around an economic center. There's going to be traffic because people have to get to and fro, and the expensive, real estate generally is going to be located in the city center, and people move outside, or whatever. And public transportation is obviously a way to mitigate traffic. We think that tunneling is probably one of the most practical solutions to creating great public infrastructure to mitigate traffic that is like effectively ignored. I mean, it's almost equivalent to, in sort of the, climate change debate of nuclear energy or something. It's like, we have a solution. Okay. Like, have you been to New York City? How does the subway work? It goes underneath everything, right? Like, have you been people talk about, how great Europe is. It's like, one of the things that is pretty great about European cities is public transportation. It actually is really great. And they go underneath. So it's, and when you look at like the costs that are estimated and then blown through on the tunneling projects that do exist in the United States, it's mind-boggling. And so we were always kind of obsessed with this, almost we have a policy institute called the Sister Institute, and we were looking at traffic. And so tunneling became a thing we had studied. And then luckily at the same time, Elon decided to kind of start the Boring Company. So we've been investors there, and we think it's a huge opportunity, to just basically make cities work better. And the economics, similar to how, Elon has approached other of these big technical problems, we think there's just as much sort of fat, in the cost of tunneling that you can address through first principles as we've seen in, space and, and other areas.
Maybe with the technology Elon brings to it, there'll be more opportunity for tunneling and more efficient. It'll be more useful, right? Possibly.
I mean, that's the whole pitch, right? If you can make it cheaper and much faster, which, knock on wood, but they're demonstrating, then hopefully what you can do is you can overcome the massive, friction required to sell basically infrastructure to cities, right? It's just non-trivial to do, but if you can be good enough and, basically better enough relative to the incumbent solution, I think, at least we are big believers that eventually that wins. Maybe we're irrationally optimistic, but we think eventually that breaks through.
So Drew, there's plenty of places to invest. The bond market's been terrible the last year or so, but now the yields are getting better. Stock market average is about 10%, maybe tech a little bit more. So why are you so focused on this private area? And just share with our folks what the opportunities really are there.
Yeah, well, what I would say is, true venture capital, which is, I feel like what we do. And again, that's the early messy stuff. It's a very small part of the economy. There's really only, maybe 100 or a few hundred firms that focus on it. In dedicated way. Obviously, there's maybe thousands of firms that do it, in addition to other things. And so what I would say is it's always going to be a small part of the overall asset allocation pie. And that, I think that's good if it's small, because the liquidity cycles are super long, right? 10 plus years in many cases. The risk is high. If you're going to make, 30, 40, 50% net returns, that requires that you're going to, take a lot of risk. And so even the best, venture capital, managers are going to have, some blowups, for sure. So I think it's always important to frame it that way, because it fits within a portfolio. It's like, those old commercials about, part of a balanced daily breakfast or whatever. It's like the orange on the side or whatever, the small part of the breakfast was. But that's how I view it. The reason that I'm dedicated to it is because, one, it's where my passion lies. Two, it's kind of, I was so fortunate to get into the position that I was in so young, and be given an opportunity that I've just kind of just decided to just dedicate my life to it. And it's really interesting. Like, I get to every day hear about someone's dream, and they, even if it's, and I remind myself this anytime, I'm sitting on 10 Zooms in a row, and I'm like, wow, like, this person this is their dream. They've spent hundreds and hundreds and hundreds of hours to come teach me about it. What an unbelievable privilege. And I think that's why people are attracted, right? Even people who are outside of other industries, because they see something in that sort of dream.
Yeah. So there's dreams, there's opportunities, and it's exciting.
Yes. But it's also incredibly messy, right? So the flip side of it is that when someone's dream blows up, like, they're not, it's not necessarily the easiest thing, right? So that's the flip side. That's the flip side of it, which is, I would say, the reason why I don't think you want, unless you're a practitioner like me, where you put all your eggs in the basket, because that's what you do. But if you think about it on an asset management perspective, it's a small part, because frankly, it doesn't scale super well. So, if you're able to deploy like hundreds of billions of dollars into an asset class, like, I wouldn't call that venture. I'd call that something else. Could be a great investment, but it's probably not venture per se.
Right.
And the other thing is just the liquidity profile is very long. And so for certain needs, right, it's just not a great fit, because it's very good at compounding capital in a super tax efficient way at a very high rate, if done well. It's not good at producing cash flow to, use to eat tomorrow. And so, it's, I think it will always be correctly a smaller part of the overall ecosystem, but it is outsized, I think, in our minds because of this, because of the, I think as Americans, we love the optimism, the dreaming, and then many of the most iconic companies will be started and venture backed. So they seem like they're much, it's a much bigger industry than ultimately is.
So bringing this down to the high net worth or ultra high net worth investor, the qualified investor, for example, what kind of involvement should they have? I mean, you're a lifer, or you're in a crowd of people that do that. What should the basic investor, not the mass affluent investor, but the fully sophisticated, what should they do in this space?
I think that, assuming that, the liquidity profile fits what they need, right?
No liquidity, right?
Yeah, exactly. No liquidity, exactly.
No liquidity.
Yeah, exactly. Or highly lumpy liquidity, right? I think they should definitely be involved in it. I think there's, and I think there's a few ways to do it. I think one way to do it is, more passively, just in funds. And I would focus on, getting into, at least a few. I think one thing that's underappreciated by many people is you can actually network your way in to top funds, especially if you're, if anyone who, is thinking about writing a check into a venture capital fund, they've been really successful. And in, whether they're a doctor or they're a lawyer, they're a, business owner, they're an entrepreneur, they're an athlete, professional athlete, whatever. And if you approach it that way, venture capital and startups are like a super sort of business development network driven place. So people respect it and respect the hustle a bit. So one is I'd say like, don't think you can't get direct access to top funds. You just got to kind of approach it yourself and in a kind of an entrepreneurial way. We have many people that, that have become great partners of ours, that we've met through, things like that. And so I would go into funds at the early stage regardless. And then the second kind of part of the strategy you can layer on is you're really passionate about it, or you're involved in, either your local, community, kind of venture startup world or whatever, or you just, build really good relationships with your managers. You can start doing direct investing, but what I would do is you need to do a lot, and you need to do a much smaller amount in each deal than you think. So if we're in think of one of our funds. One of our funds might have 40 seed investments, 20, 25 core investments, and then like 5 that we double or triple down into, right? So if we're that diversified, why wouldn't, someone who's maybe doing it not as a full-time job not be diversified? Sometimes I see folks who are high net worth, but $1 million in one seed deal. And I'm like, man, unless you're a billionaire and liquid, that's either just like a one-off thing, not a strategy, or what are you gonna do that? You know that 100 times, you get about $100 million to work, like in early stage seed deals. I mean, it's a high risk thing to do. So I tell people, pick size the amount you want exposed to this over the next 10 years, divide it up and put the same amount in every single opportunity you see, because you don't have the ability to bet size properly, and you want a diversified portfolio if you're going to try to do it direct. And if that sounds daunting, and you don't want to take 10 to 50 meetings for every single check you write, probably more like 40, 50, then just don't do it. Just let use the amount of management fees you're paying to a venture manager is tiny relative to the amount of time you're going to spend, taking hundreds of meetings a year. So only do it if you're super passionate about it. But I think the thing that people do sometimes, they think, oh, I could never get into, a venture fund directly. But I think that's actually not the case. I think you can many times.
You can. Well, and that's a really good lead in, Drew. We didn't talk about this earlier, but Fourstar has launched the Diversified Alternative Fund. And that is our URL, diversifiedalternativefunds.com. If you go on there, you'll see two funds that are part of it that have 3 buckets each. And one of those buckets in the Opportunity Fund is an angel early stage fund. So I would certainly not recommend anyone do angel and early stage investing on a one or two off basis. You've got to have 25 or 30 different investments, or else you'll lose. The likelihood of success is very small. And it sounds like the same thing with you, and on a much larger scale. And that fund you can get in for 100,000, Drew. So that's a way to do it. But
that's great. I mean, I think
have to be a qualified investor to do it.
Yeah, I mean, I think that everyone should have exposure to it, but I think through funds is the right starting place, and then you can decide basically from there how much time you want to spend on it, how you kind of want to approach it from there, because the next step does require a lot of time, which for some people is that's how they want to spend their retirement, which is great. I think you should do it. The one caveat I would say on it is, again, it comes down to building an ecosystem around yourself. So the funds are one part of that, but then 2, it becomes, okay, are you investing in a specific geography, or you built a business in a specific area? Maybe you're only going to focus on that. That is like narrowing the world down, while still being diversified within that world is, I think, very smart, because otherwise we've always asked ourselves, is this our money to be made, right? One of the reasons we never invested in China is we never felt there was any way we were going to see the best deals, because we weren't on the ground there. We didn't go to the right schools. We didn't speak the language. We have a lot of respect. I mean, those people are working incredibly hard, incredibly smart, right? Why would they send us a deal? And so we ask ourselves that question, and we're doing it, 24/7. So I think people should ask themselves that question. If you're a top physician in a specific area, you can get into all of the best deals in that space. I promise you, you underestimate how easy it will be for you to get into top deals. But don't try to do like logistics software. Just focus on your sweet spot, or you have expertise. If you built a really large janitorial supply company, maybe don't do biotech, but the logistics supply chain, you could see a lot of stuff because people will want your actual strategic advice. And I think the best way you source around that is through funds.
Exactly. Well, great. Well, Drew, this has been a great discussion. You are in a very, very successful place as a very young man. So that's congratulations to you, and really great to hear what's going on in the early stage markets. And we'll look to hopefully visit with you again and get an update if you're up for that later on.
Yeah, of course. Would love it.
Excellent. All right. Well, we'll leave it there. Drew, thanks for being with us today. And thanks everybody for listening to this latest episode and listening to Drew about all the great stories in early stage investing. We're happy to discuss with any investors about the 4Stars Diversified Alternative Fund. And then, of course, as Drew says, investing for larger amounts in different organizations. As long as you can diversify well, it's important to diversify. Yes. But thanks again, Drew. Really appreciate your time.
Thank you so much, Brian. Appreciate it.
Okay. We'll leave it there, everybody. We'll be back with another great episode with another great guest like Drew. We'll leave it there for today's Market Explained, a 4-Star Media event. Thanks, everybody. Goodbye for now.